All right, so we finally got here to the section 5 of 5. So this completes the videos for the advanced certification for 2022. And just like in section 4, I didn't use any of the important. I just have all the questions and the summary pages because there's a lot to cover. So the first thing we look at in this section is reviewing lists at the end of period. In section 5, we'll be revisiting many topics, starting with reviewing lists. Clients can make mistakes when they input or connect their lists. These mistakes can have negative consequences on their QBO account. These errors may not be detected until period end, when you are reviewing your client's vendors, customers, product and services, and chart of account lists. It's usually only then you can identify and fix these errors. What lists would you need to review or any issues to possibly address? Will you have the vendor and customer lists, duplicates in the product and service item list? The chart of accounts could be simplified by weeding out any inactive or duplicate accounts. Clients may be close to their usage limits. If they have anything other than advanced, they have to have that 250 for, let's say, chart of accounts. The review may need to be performed on a regular basis, so you should sit with your client and agree on a schedule. You may want to review the lists of clients new to QBO more often and teach them the best practices when you see they begin to make mistakes. It's advisable that you start reviewing your client's chart of accounts to see if they make sense for that particular client and run through the following questions. Is the chart of accounts accurate for their industry? Does your client use sub-accounts? If not, do they want to learn more about the topic? If the client isn't an advanced user, are they approaching their limit of 250 accounts? Can any of these accounts be made inactive? Reviewing the chart of accounts. Know what the common errors are so you can look for them. One is setting up an account incorrectly. This could make the financial statements inaccurate. Another common error is using a number system that doesn't make sense. Or when clients create an expense account for the purchase of products when that shouldn't be an expense account, rather it should be a cost of goods sold type. If so, then the gross profit would be incorrect. Review the balance sheet and profit and loss reports. Look for default accounts like uncategorized expenses, uncategorized income, open balance equity, etc. Also search for unusual balances. For example, a large balance in an account like miscellaneous expenses may indicate that you need to add additional accounts a little bit more clearly to define those type of expenses. Review the audit log. You can always use the audit log to filter and search for default accounts, unusual activity, or repeat transactions. When reviewing the chart of accounts, if you find duplicates, you can merge accounts, or if you find accounts not being used, you can make them inactive. You can merge accounts that contain a duplicate name or activity. So for example, membership dues and subscriptions. That was something we had in a class a couple of years back. For some reason in this book they had both of them, and then later on in the middle of the book we decided to merge those two accounts because we saw a lot of students were using those two separate accounts. Like I think it was a typo in the book. So if you see that there's a particular account and chart of accounts that really, stand for the same type of thing. I had a client who had Office 365 expense, and then they had other software expenses. I said, why don't we just bring them all into one, as opposed to using several different ones. This combines the activity into one account and makes the other one inactive. We explored this in the Pro Advisor exam training video, if you remember. Remember that merging accounts is not reversible, so that it may cause changes into the prior year information. To merge accounts, make sure both accounts are the same account type and detail type. Edit the account you want to keep, copy the name, and then close the account. Edit the account you don't want to keep and paste the name. When done, select Save, and then the little pop-up window comes on and you'll select Yes to confirm that you want to merge these two accounts. Note that you must make sure that any sub-accounts that are associated with this parent are the same. So if you're merging two parent accounts, you must make sure that they don't have any sub-accounts. Accounts connected to online banking cannot be merged. Okay, so make sure they don't have any sub-accounts, and anything that's connected to an online bank feed cannot be merged. If and when your client gets closer to the usage limit of the 250 accounts, if they're in plus or lower, then begin to look for accounts to make inactive. So, and again, those are your non-advanced users. You should look for accounts that won't be used anymore, such as vehicles that they no longer have, or maybe a loan that's been paid off. To make an account inactive, you go down to the right, you go down to the action drop down and select make inactive. Keep in mind that when you make an account inactive, QBO hides that account from the list and the drop down menus. However, it does keep a record of past transactions. If you run a transaction-based report and there are transactions in that account during that period, that account will show up with the word deleted at the end of its name. If you try to make a balance sheet account that has a balance inactive, QBO will have this pop-up window that you see right there. This account has a non-zero balance. If you continue deactivating the account, QBO will create a journal entry to zero it out and post it to Open Balance Equity. This entry is dated the day you made the account inactive. That's why it's best to reclassify the balance before making the account inactive. So reclassify it, get that account down to zero. You can see inactive accounts later if you choose to reactivate them. So you'd go to the grid gear icon at the top right of your chart of accounts and select Include Inactive checkbox to see your inactive accounts. You need to take additional steps before deleting certain account types. Here are a few examples. You want to make an account inactive and it's used in an active product or service. In this case, you need to edit the product service and change the mapping of the account it's connected to. Alternatively, you can make the product or service that you use itself inactive. An income account you want to delete that has pending billable charges. Your client should invoice their customer for the billable charges, times, and delays. Or you can go back to the billable expense and then just remove that check mark under billable status. Also, delete any delayed charges that won't be invoiced. Once you've done so, you can make that account inactive. What if the account has sub-accounts? You cannot make an account with active sub-accounts inactive. You'll inactivate all the sub-accounts. Also note reactivating the account. So once you reactivate the account, the sub-accounts will not be reactivated. Only the parent account will. So what will happen is the sub-accounts will have to be reactivated individually from scratch like you did initially. There are usually two issues that are found when reviewing product and service lists. The product or service is not mapped to the correct account. So remember when we set up inventory or non-inventory or anything, you have to map them to cost of goods sold and income count and so on. One example is a service item that was set up as a double-sided item, meaning you sell this item as well as you buy from whatever it is. Both sides post to a service income account and then on the other side. In this case, reports are going to have errors. So, okay, I'm sorry, this is a service item. So what you did was you created a service item, not an inventory or non-inventory. You served a service item as a double-sided item, and they shouldn't. We'll look at an example a little further up as what a double-sided item is. I'll show you the screen of it on an inventory or non-inventory item. The other one is the product or service is not set up as a two-sided or double-sided item, meaning that it cannot be used on both sales and purchase forms. That's the one we're going to look at. To review the account mapping, perform the following steps. Go to the product and service list, select the grid gear icon. Make sure the income, expense, and inventory accounts are selected with all accounts displayed, and then check all the items that are appropriately coded to the correct accounts and edit the items as necessary. If you change any of the three accounts for an inventory item, their income account, asset account, and cost of goods account, those are the three, QBO will automatically change historical transactions. This may affect prior period numbers. So what they're saying is if you were to change, if you had a different account associated as the income account and you change it, that means all the historical transactions will change along once you make that change. If you change the income or expense account associated with a non-inventory or service type item, QBO gives you the option to, in a checkbox, also update this account in historical transactions. If you don't check the box, QBO will use the account from that date going forward. It doesn't change any postings to any prior transactions. Either way, when you select Save and Close, if this change affects any historical transactions dated on or before the current closing date, you will be prompted to select Save Again because it'll give you that warning. If you really want to make that change, you would push it. All right, so here's where you would see also update this account in any historical transactions. And then here's the one I was telling you about. So if we want to make it double-sided, so if your client wants to do a job costing and see both item profitability, you should set up product and services as double-sided or two-sided items. This means that you can use the item on both sales and purchase forms. So to be able to do that, you would have to do the check mark, I will sell this product or service to my customer, as well as I purchase this product from a vendor. So you'd have to select both of those for it to be double-sided. You also need to make sure that in the expense tab in the accounts and settings section, the setting to show item table on expense and purchase form is enabled. So as you can see, you go to gear icon, accounts setting, you go down to the expense tab, and you just want to make sure the slider is moved over. When reviewing customers and vendors list, first identify any duplicate customers or vendors and then merge them. Duplicates might arise due to incorrect spelling or punctuation, or when different display name as choices are used for the same customer or vendor. If there is a first and last name and a business name, you could specify the display name as either the company name, the contact person, and then you could select whether it's last name first or first name first. How do you identify any duplicates in this list? You can run a customer vendor contact list report grouped by billing zip or shipping zip if applicable, and then add a column for phone numbers to help identify any duplicates. You might want to go over the list with your client because they're more likely to spot any duplicates. How do you merge any duplicates? To merge names, you change the display name as field on the customer vendor. You don't want to keep the display name on the customer vendor. You want to keep. So the QBO will recognize that there's another one, and this pop-up window will come up and say, please confirm that name already exists. Do you want to merge? And you would say yes. So select yes, and all transactions will be moved to that remaining name. However, because QBO never deletes list entries, the old name will still be there. It'll just be inactive. When reviewing the customer and vendor lists with your client, ask them to identify any customers or vendors they no longer do business with. If your client uses sub-customers for job tracking, have them identify any sub-customers that they're no longer using. Then make these customers or sub-customers inactive by editing the customer detail and selecting Make Inactive at the bottom. If you have a few of them that you need to make inactive, then check each customer or sub-customer in the Customer Center, and then under Batch Actions, then select Make Inactive. You may also see issues related to payment for sub-customers being applied incorrectly. So that means that when you set it up, you didn't select the proper one. So when you set up a sub-customer, you have the option of either making it bill to this customer or bill with parent. So if you selected the wrong one, you need to just go back and select the proper one. So when the client uses bill with parent, it would be easy for them to receive payment using the parent customer's name and apply the payment against the wrong sub-customer. How do you find any unapplied payments? To quickly find unapplied payments for a customer, open the customer transaction list page and filter for money received, and then select the status column. You may have to select a grid. The grid gear icon display the status column first to add the status column to the page. Any open payments will be listed at the top. How do you fix any errors? To fix errors, you would select the open payment and change the name to correct any sub-customers. However, before you correct the sub-customer's name, make sure that you write down the amount received first. That is because QBO will zero out that amount. You then need to re-enter the amount received on the screen for the correct sub-customer. If you have an inactive customer who has an open balance, QBO will create a credit memo using a service item that it's set up. This service item posts against the service income account, which QBO also sets up. What if there are any outstanding invoices for this customer? You should write off the customer invoices by either creating a credit memo or using the write-off invoice tool. We'll look at that a little later. Then creating the appropriate transaction, whether it's a bill, vendor credit, or journal entry, to zero out the balance on a vendor account before you deactivate the name. If you inactivate a vendor that has an open balance, then QBO will create a vendor credit for the amount of the open payable and post it to miscellaneous expense. To control the posting account, you should create a vendor credit before you make that vendor inactive so you don't have to do that extra step. So here we are with a summary page, our first summary page. Here's a few questions that you're definitely going to want to have in your notes. Why might QBO stop you from inactivating a general ledger account? The answer could be the account has active sub-accounts. So why might? Here's one answer. You want to make sure you have all of them in your notes. Excuse me. Sorry, I'm a little sick. So you're going to want to have everything in your notes because this one just happens to be that answer, but there may be other answers applicable, so you want to make sure you have those in your notes. Here's another question. Which two situations require extra steps before deleting accounts? Here are the two answers. If an account you want to make inactive is used in an active product or service, and the other one is if an account you want to make inactive has pending billable charges. Again, you want to have all of the situations in your notes. The client has two customer names for one customer. What is the most efficient way to get all of the transactions for both set of customers' records to appear under the same correct name? The answer is edit the incorrect customer name to exactly match the correct customer name and then merge. Excuse me, I'm sorry. All right, so I have a question coming up, and this is the picture that goes with it. So this is a chart of accounts. The question is going to ask us which one can we merge. So I want you to notice, remember when we talked about merging, you have to have the same account type and detail type. So you're going to look over here, and I hope you can see this, but office and office expenses both have expenses and office general administrative expenses. So these two counts could be merged, office and office expenses. If you scroll down, you might have to zoom in this a little bit. I don't know, or get a larger screen if you can't see this. The other two is other income and other portfolio income. They both have income and other primary income. So remember, to merge, they have to have the same type. So the question was, look at the above chart of accounts. Which two pairs of accounts will QuickBooks Online allow you to merge? And again, the answers were office and office expenses and other income and other portfolio income because they have the same account type and detail type. So the next topic we're going to look at is reviewing balance sheet accounts balances. Reviewing your client's accounts is an integral part of your year-end period procedure, or end of period. So it could be quarterly or monthly if your period is quarterly or monthly. Mistakes can be easily made, but often hard to spot until the period ends. With QBO, you can work with your clients to identify and fix any mistakes that could result in errors on their books. You need to make sure that balances are correct, but also to determine the correct workflow for the client. One workflow is using clearing accounts. I have a video on clearing accounts if you're not familiar with them. A clearing account is a temporary account used to wash special use accounts. So for example, you can clean up undeposited funds accounts or adjust for donated inventory, entering a $0 transaction. We talked about in the last video. A clearing account should be a bank type account. Sorry. Make sure you don't enter an account balance before selecting save and close. It should always have a zero balance. If the entries that affect it were recorded correctly and completely, the monies just simply go in and then are held there until you move them into the appropriate account. So like undeposited funds, you hold it there until the actual deposit goes through and then you put it in your bank account. Again, I have a video on that if you're not familiar with that. What if the balance isn't zero or you don't find an offsetting transaction? If the balance isn't zero, reconcile the account to see which transaction might be missing. When you start to reconcile a clearing account, the beginning balance is zero and should always be zero. You should always enter zero as the ending balance as well, regardless of what shows there. So if it does have a negative or positive, you're still going to put zero. And then when everything comes up, you're going to look and see, well, it doesn't look right. If there's a beginning balance, it means that someone forced a reconciliation, meaning the difference on the reconciliation was not zero and they still pushed finish now. As you're going through the reconciliation, look for any non-zero transactions that have an equal and opposite offsetting transaction and clear both sides. The difference should be always zero. Always mark a $0 transaction is cleared. If you find a transaction that should have a corresponding match, search for the dollar amount and see where that offsetting transaction might have been posted incorrectly to. It may have been posted to an expense or income account instead of against the clearing account. So 3 steps to spot and fix issues with your bank or credit card accounts. Step 1, check the account balance. Make sure that these accounts are reconciled to the bank statement. You'll also want to review the account to see if there's any old outstanding transactions that might have been written off. For example, in a bank account, an old outstanding transaction could be a paper check that has been posted to the bank register but has not been cashed. In a credit card account, it could be a duplicate credit card payment that is causing, I mean, that's happened to me. Sometimes you by mistake push it twice and you have a duplicate credit card that needs to be, resolved. Once the bank source account, bank feed, posted payment twice. Once the bank source account's bank feed and another time from the, I don't even understand what this is saying, that was caused by posting the payment twice. Once the bank source account's bank feed and another time for the, I'm not really sure what they're saying, but you know what I mean. Sometimes you by mistake post it twice. It could be an error by your bank and it's not in your records, obviously, because it shouldn't have went in twice. So you would have to take care of that. Step 2, find outstanding transactions. You can easily view outstanding transactions from a balance sheet account as follows. Open the relevant bank or credit card account register from the chart of accounts, and then select, you double click it or you go down the bottom and view register. Select the filter icon. From the reconcile status dropdown, you want to select not reconciled. Enter the end date in the to fields and then select apply. This will show you your outstanding transactions up until the period end date, shown as here. Step 3, resolve any errors. If you find an outstanding transaction, discuss them with your client and determine if you need to make any adjustments. Depending on the error, you may need to void a transaction, delete a duplicate transaction, add a new transaction's date in the current period because an old transaction was dated in a prior period, adjust existing entries. Actually, you know what? I said that as an example, but that really happened to me with a client. They actually had a particular vendor that constantly was double charging them by mistake. They were saying that it was because of a delay or lag on their end with making the payment, but I don't think that's what it was. But that's a good way to catch those kind of, you might not have caught it, because you have so many credit cards. So fixed asset accounts. Those are equipment, furniture, building, and vehicles. Fixed assets are usually higher dollar amount purchases that the business itself will use, so they're non-inventory. What do you need to check? Review any fixed asset account to make sure that there are separate accounts on the balance sheet for both the original costs and the accumulated depreciation, because most of them have, you can apply accumulated depreciation. Review the transactions posted to these accounts to make sure that they are appropriately posted in. You should also review accounts like office supplies or auto expenses to make sure there's no fixed assets that were incorrectly posted to these accounts. Ask your client if they sold or disposed of any fixed assets so that you can then, or the taxpayer can do the appropriate write-off entries. 3 steps to spot and fix any accounts receivable accounts. So checking this account. Run the open invoice report dated at the beginning of the period that you're reviewing. For example, change the report date to last year if you need to. Also, make sure to choose report date as the aging method. Then compare the open invoice report to the balance sheet for the same date. Review the balances to see if they look right. If you find any errors, investigate and then solve them. Step 2. Finding and investigating errors. The type of errors you might see include the balance sheet does not agree with the total on the open invoice report, and customers show a 0 balance but have 2 or more offsetting transactions that equal 0. Customers have old open balances. This could mean the outstanding invoice that their unpaid balances have been written off because they were uncollectible, and AR is overstated because someone posted a deposit directly to income rather than as a payment received. So, sometimes that happens. You create an invoice, and then when the person sends in the check, maybe you have a new bookkeeper that you're training, and they get that check in, and they automatically put that directly in as a sale instead of to payment received. So it's going to still show that that customer owes money. Step 3, resolving any errors. Once you're investigating any errors in your AR accounts, you can work with your client to resolve them. Here are some fixes for common errors. So error, reports don't agree. If the balance sheet doesn't agree with the open invoice report, check the dates of both reports and the aging method on the open invoice report. If you run the report as of a date in the past year, make sure you have the appropriate one, and the age method is current. It will show any invoices dated prior to the date of the report that's still open. It won't include any invoices that were open as of the report date, but have been paid between the report date and today. So to correct this, change the aging method to report date. And what if you have the error, the open invoice report shows customers with zero balances? So a customer with a zero balance should not show up in your open invoice report. If a customer does show up and they have offsetting transaction, it means that the offsetting transactions weren't applied. So the problem could be an open invoice with a received payment, as I just discussed a few minutes ago if you had a new bank. In this case, the payment may have been received before the invoice was created. Oh, so sometimes you might have, you know, you're really, it should be a sales receipt possibly, but you might have it where you know you have to bill, but you never got it in. They made the payment first and then you made the bill after. You would then open the transaction, check off the invoice to which it applied, ensuring that the payment amount was unchanged, and then this will take those transactions off the report. Another reason the AR could show a zero balance is if the bank deposit was posted to both the AR and the customer. To fix this, open a new receive payment transaction, enter the customer's name, check the bank deposit in the credit area and the corresponding invoice to which it should be applied to, and then save. This will apply the two entries against one another and thus zeroing out that open AR balance. Okay, error. What if you have an old open accounts receivable? I know this is one of the questions on the test, so I was just looking it over. In this situation, go over the list of old open invoices with your client. You need to write off small dollar amounts or amounts of any size that are going to be collected. If you have determined AR is overstated because someone posted a deposit directly to income rather than receiving payment, as the same example we used before, the simplest way to resolve this issue is to complete the revenue cycle all over again incorrectly. To do this, you would record the payments against the invoice, go back to the erroneous deposit that was posted to income, select the invoice to which it should apply to, delete any incorrect distribution lines posted to the income account. This corrects the accounts receivable balance and the revenue without affecting the bank account reconciliation status. It is the most accurate approach because it preserves the integrity of the traditional revenue cycle and the AR workflow. Here are 3 steps to spot and fix issues with AP, our accounts payable. First, run any unpaid bills report dated at different, times, depending if you do it in monthly, quarterly, you're going to do it at the end of that period. For example, change the report to last year and then do it for that report date. Then compare the unpaid bill report to the balance sheet for that same date. See if there's any errors and then fix them. Finding and investigating errors. The type of errors you might see would be the balance sheet doesn't agree with the total unpaid bills report, as we just said. Vendors show a zero balance, just like we saw with the AR. There may be a bill and bill payment, or a bill and vendor credit, or a bill and an expense posted to AP. Those all 3 could be issues. Vendors that have old open balances could mean that a vendor credit will need to be recorded because a bill was never paid, or someone posted a purchase using a check or expense transaction rather than paying a bill. So same thing as you saw before. They created a bill and then with the check, they instead just wrote a check again instead of putting it as pay bill. Step 3, resolve any errors. So again, the reports don't agree. Same thing, they're just on the other side. You want to run the unpaid bill report to current. You want to see if you can find any of those specific areas. As we stated before, double click on it and make the appropriate adjustments. If you find any vendor showing that zero balance, but then there's still that open bill and bill pay, then you go in and you adjust accordingly. Old open accounts payable. If the outstanding balance is a small amount or a bill that won't be paid, you could fix this by creating a vendor credit to write off any outstanding balance. You'll want to date it to be the last day of the period you're reviewing. I don't know why this might be happening, but maybe your vendor went out of business, so you're not going to pay it, and you would make the adjustment accordingly. If the amount is equal to the bill, add the bill for the drawer as shown below. The bill will overwrite the existing transaction on the check and change the transaction type to bill payment, and then you would select Save and Close. If the check was a partial payment, add the bill to the drawer, edit the amount in the field because it automatically will put the total amount. Instead, you're going to put whatever the partial payment is, and then go to Select save and close. Using a journal entry for AR and AP. So it would take too much time to collect large numbers of incorrect entries in either accounts receivable or accounts payable by working through them one by one, especially if you need to write them off or zero out a bunch of small balances. Instead, you can create a journal entry. Just note, the one thing that I would say out of this is when you do that journal entry, you can't tie that directly to an invoice. So that's one of the downfalls here. You're going to add an AR line to credit each customer balance if it's large enough, but if it's not, just a bunch small of them, you're just going to make one, and then you have to go back and go to each one. Like it says here, you don't want to lose the integrity of the workflow, so you would have to go back and make sure you appropriately correct the invoice and the receipt payment workflow. And then on the AP side, you would debit each vendor's balance and credit the expense account, and basically the same steps. You could read this over. Troubleshooting liabilities. You should be able to fix most issues with liabilities by taking the following steps. So you have loan accounts. Obtain statements from the loan originator and make sure that the balance on the statement matches the balance sheet's balances. If interest was not split out for each payment, you need to make a proper record as putting, a journal entry to reclassify the interest and interest expense. You could also reconcile these accounts to ensure nothing is missing or nothing unnecessary was included to any of these accounts. Then you have sales tax payable accounts. You should be able to compare the balance in any sales tax payable account to future payments made or amounts that show due on the sales tax returns. If they don't match, you need to investigate. Troubleshooting open balance equity and retained earnings. So this open balance equity has been definitely an issue in my classes. So that's an account used when a company first set up QBO, and that's the only time you should see open balance equity is in the initial journal entry of starting your company. Once the company is set up, the balance should be zero after that, as I just said. There should be no additional transactions posted to this account. However, some clients' actions can generate entries to this account. So for example, if you're connecting an existing bank account to your new QBO account, and you're showing zero, but you have monies in that account, so you didn't appropriately establish that bank account, then that money is going to go immediately into open balance equity. Or if you're creating a new inventory product and the initial quantity on hand, you put something in there instead of appropriately taking the step of recording when the purchase was, then automatically that'll go into opening balance. Adding a new balance sheet account and entering an opening balance. So, when you're setting up an asset, is there, an opening balance? If you put an open balance in there, it is automatically going to go to open balance equity. And then the last one is deactivating a balance sheet account that has an open balance. So remember, you want to clear that out first before you deactivate it. What can you do to fix these errors? So I'm pretty sure as I was going through, I said it, but if the balance for your open balance equity is zero, then you would need go to your chart of accounts, open it up, look at that transaction list and see what's going on. Where did that, double click on there and make any appropriate adjustments. The retained earning account is a rollover for net profit at the end of the year, or the end of the fiscal year. But for most businesses, that'd be December 31st. So as of January 1st, whatever your net income or net loss, it automatically goes into that retained earning account. Okay, so I have that here. At the end of the year, QBO automatically swaps the funds from net income or net loss into your retained earning account and doesn't record any visible transactions. It just automatically happens once you close your books. Retained earnings is the only balance sheet account that does not have a register. To see there are any user-created transactions affecting the retained earning account, you would run report from the action column in the chart of accounts. If you find any transactions there, you would need to speak with your client and find out, or your tax preparer or accountant needs to speak with the client and find out where these entries came from. So here are our questions for this section. Why might a QBO stop you from inactivating a general ledger account? The answer would be a balance sheet account with an open balance was made inactive. Here's another question. What filter do you use to find old outstanding transactions in the register? You would use the filter reconcile status and then not reconciled. Your client has decided to use a journal entry as of the year end to write off small accounts receivable balances. What is the downside to this method? Remember, I said it earlier, journal entries can't be applied directly to invoices. So that's that direct write-off method if it sounds familiar to you. Okay. Review profit and loss and uncategorized account balances. Clients sometimes make simple mistakes, such as posting transactions to the wrong account type or setting up products and services incorrectly. When this happens, accounts might have an incorrect balance, such as non-zero, at the end of the period. In addition, QBO might post transactions that can't categorize to uncategorized account. So, what can you do to fix these errors? During your end of period reviews, you should always check the client's profit and loss accounts, plus any uncategorized accounts, so you directly get those from your chart of accounts, to make sure that the account balances are correct. With QBO, you can work with your client to identify and fix any mistakes that could create errors to their account. You need to correct any balances as needed and also determine the correct workflow for the client. Comparing income to the sales by product service summary balance. Before you start to review individual profit and loss accounts, you should check that the balance on the sales by product service summary report matches the income for that same period. If the two figures don't match, you need to investigate the discrepancy. Step 1, you're going to run a sales by product service detail or summary report and summary report, and then get the total sales for each product or service if you have both. And you'll find this report in the sales and customer section of the report center. I think I have a picture of it in the next slide. Or by using the search fields in the header section. To view the fine detail of this information, run a sales by product service detail report for the same period. This report shows all products and services used on sales transactions for that period, including those mapped to any asset or liability account. This may happen if a retainer item was used on an invoice. We looked at that in section 4. So if you're in reports and you go to sales and customers, it's right here, those two reports. Step 2, you're going to run a profit and loss report for the same period to get the income for this period. Compare the sales by product and service report to the income of the profit and loss report. What if the profit and loss and the sales and product does not match? Those two reports, what if they don't match? There's several possible causes for this discrepancy. Sometimes it may be posting incorrectly to the income accounts, or there could be an issue in how many products and services are set up. There are several possible causes. You would have to just look into it. You'd have to open up the registers or go to those reports and double click and go down and figure out where the errors are. Product and services posted to non-income accounts. So sometimes these items on invoices or credit memos or sales receipts legitimately post to non-income accounts, such as client retainers or bad debt expense. In this case, you should customize the sales by product service detail report so that it filters out those non-income items. To do this, you would filter the distribution account for all income accounts in the drop-down menu. You would then filter that same report by using you would filter the detail report because the summary report can't be filtered by that. And then you would select run report. Now you can see the totals of all sales transaction for the period that affected that income account. And these two reports then should agree, the profit and loss and then the detail. Product and services set up incorrectly. Sometimes product and service item income accounts may have been mapped incorrectly. For example, they might be mapped to an expense account rather than an income account, or the opposite. The expense account might have been posted to an income account when you were first creating that product and service item. So you will find these errors by customizing the product service list to add columns for the income account and expense account. First, you would sort the customized product service list by the income account. Then you would edit any items that have incorrect income account mappings. If necessary, check the box next to also update this account in historical transactions, as we've seen earlier as the option. And then you sort the report by expense account and then do the same thing. Select also update this account in historical transactions. What if some of these historical transactions are in closed periods? In this case, uncheck that box, save the changed mapping, run a quick report for transactions using this particular item, and then edit each transaction accordingly, and then save. Troubleshooting wages and payroll tax expenses or accounts. You should be able to compare wages and payroll tax accounts to the payroll returns to make sure they agree. If you can't do this, someone may have incorrectly posted transactions to one of these accounts. What should you do if the wages and payroll tax accounts do not agree with filled payroll returns? Run a transaction detail report for either the wage and tax account or investigate any transactions that are not payroll type transactions. Check for a reconciliation discrepancy account. Suppose you see reconciliation discrepancy account in your client's chart of accounts. That means that a client forced a reconciliation when it wasn't zero. So when you're doing a reconciliation and you check everything that went through and you don't see zero, but you click finish now and you force it, then automatically a default account called reconciliation discrepancy account gets created, okay? And then you're going to need to look into it and further scrutinize and figure out what is this, and then that reconciliation might need to be undone and re-reconciled correctly. How can a client force a reconciliation? Well, I just explained it. So you're reconciling and then your balance is not zero and you force it by pushing finish now. That's how you force it. When the QBO displays the following message, okay, hold on, your difference isn't zero, and they push, go ahead, I want, then that's how, and then you click done, and then it unfortunately forces it. QBO adds a reconciliation discrepancy account to the chart of accounts as shown here. So now when you come here, you go, oh, what's this? When you see this is a good, just like we say, there's certain things, uncategorized income, uncategorized expense, open balance equity, those things to be zero. If you see reconciliation discrepancy, pro advisors, that's another thing. Wait a minute, this shouldn't be an account with a balance. So that's a ding, ding, ding. I need to do an audit. How can you fix this? This is where you come in, you select Run Report. In the action column over here, you would go down here to Run Report, and you'd click on that link, and then you'd find out what's going on in there. So, and then, of course, you're going to need to reconcile it and make it zero. Now let's look at the uncategorized asset, uncategorized income, and uncategorized expense accounts. QBO adds these as default accounts. Your bank feed comes in and something gets charged and they don't know what it goes to. It automatically will go to that uncategorized account. What else could cause a transaction to appear in an uncategorized account? If the automation setting for any pre-filled forms with previously entered content is activated and someone uses an uncategorized account when entering a transaction for a vendor, QBO will suggest they use the same account next time they enter a transaction for that vendor. They might accept this suggestion without changing the account, and then it would go into an uncategorized account. So here's the questions for this section. What is the purpose of an uncategorized account? Well, to make an account that is assigned when adding a transaction through the bank feed. So step one, it usually is through your bank feed, and then we saw the other scenario of uncategorized accounts. So this is the second question. What are two reasons that the income on a profit and loss account report would not agree with the product service summary report for the same time period and reporting method? So the answer is a transaction posted to an income account using the items detail grid. Question number 3. What does the existence of a reconciliation discrepancy account with a non-zero balance in a QBO company or QBO company tell you? That means that a reconciliation was completed, but the user chose finish now even though the difference wasn't zero. They forced it. And the last one, which of these statements is true of the reconciliation discrepancies account in QBO? The answer is every QBO company has this account by default. The next topic is issues with undeposited funds. It's common for clients to use the undeposited funds account in QBO improperly. For example, businesses that receive a lot of payments by cash or check sometimes enter the receipt to undeposited funds. They then group customer payments, record them as one deposit, and then move them from undeposited funds to the bank account. But not all of them were recorded to undeposited funds, and therefore the check account in QBO will be overstated. In other cases, clients don't use the undeposited funds account at all, even when they should. So mistakes like this may not seem obvious at first, but they could cause balance issues at period end. So resolving these issues. The most accurate way to fix errors is to edit deposits incorrectly tied to income. First, you'll need to identify these deposits, and to do this, you would find the payments waiting to be added to deposit. Do this by selecting + new, and then select bank deposit. Open up the blank bank deposit screen. Any already received payments recorded to the undeposited funds will be sitting there awaiting deposit. Make a note of any transactions that are on this list that shouldn't be there. Don't enter this deposit. Just select X or cancel and exit that screen, and next find deposits and find out where they should be at, and correctly post them to the appropriate accounts. Coming back to here, it says you can go to the bank screen's categorized tab to find any downloaded bank transactions for this deposit. You can select the link to find out how it was recorded. It's all, in all likelihood, it's a bank deposit transaction. All right, then you would check the boxes next to any payments still in the select the payments included in that deposit grid to bring in those payments that are awaiting deposit. Delete the corresponding lines in the add funds to this deposit grid so that these erroneous lines are replaced with the check marks above. Ensure that the total amount of the deposit is unchanged, and then select save and close. This won't affect the reconciliation status of the deposit. While this method is time consuming, it's best way to find and fix the error because applying each individual payment to its proper deposit ensures that the report is always accurate. Another way to find these unlinked deposits is to open the register or the account history for undeposited funds. That means you go to the gear icon and add the column for reconcile and bank status, and then sort the register by reconciling status, which is the R. So you'd go down, and I don't know if you could see the picture, but it would be R or C, and you would go down that column. The undeposited funds account, by the way, that's in the training section. The undeposited funds account should only have a debit account balance. A credit balance would indicate that this deposit was dated before the received payments. In this case, you or your client should investigate and correct the dates. An efficient way to treat multiple payments is to group them from the undeposited funds account and create one deposit for a specified time period. You want to group payments and reduce income for the total amount by reducing the balance in your undeposited fund without influencing the actual bank accounts. You or your client can group all payments together in one adjustment or group them by month, depending on how you may feel this needs to be fixed. When you group open back payments by month, monthly reports reflect the correct undeposited funds and revenue amounts for that period. So how do you group payments? To do this, you would create a new deposit to a clearing account. You would select each undeposited payment for a given time period in the upper section of the screen. You enter appropriate income descriptions and amounts in the add funds to this deposit grid as negative numbers to offset the total. So there would be negative numbers, and then you would confirm that the total deposit is $0. This wouldn't affect the bank account, but it will reclassify any undeposited fund amounts against any incorrectly recorded revenue. Note that when correcting a deposit, confirm that they're using the correct income account. When the payment is posted to the undeposited funds, but the deposit is posted to income, the undeposited fund account then would be overstated. So here's our 2 questions for this section. Although it seemed like it was a long section, there's only 2 questions. You are cleaning up undeposited funds for a client. On a deposit transaction, you have selected the payments to be included and deleted the lines in the add funds to this deposit grid. What statement is true? The reconciliation status will not change. What might cause undeposited funds to be overstated? The answer is payment is posted to the undeposited funds, but the deposit is posted to income. Our next one is writing off invoices. So during the period end review, you may come across invoices that haven't been and never will be paid to the customer. This could be because the customer went out of business or it's simply not realistic to expect payment. So QBO offers several options for resolving bad debt. One of these is the write-off invoice tool, which can only be accessed through a QBO A account. There are other options to resolve bad debt, but you'll have to think carefully on which is the most appropriate for your client. When should you use the write-off tool? It's best to write off invoices in the current year where there's no sales tax involved. You can also use this tool if the client is operating on a cash basis where there's no sales tax involved, because it won't change the prior year's cash basis reports. Here's a quick recap on how to access it. So we all should know this. If you go to the top right and you select Accountant Tools, under the tools you'll see the write-off tool. Use the Invoice Age drop-down and the to date fields at the top of the list to specify the filters and find a list of potential invoices that you need to write off. So once you go into this write-off tool, you will come down here and you're going to want to go to find invoices, and over here is where you have the date and the invoice age here. And then you would select find invoices. Now that you've selected the invoices that you want to write off by checking the box to the left of them, select write off and select the account where you want the write-off to be posted. And then you would select apply. Here's an example of an invoice that's been written off. You can see that QBO zeroed out the invoice with this discount item. That's in the training. If you open the transaction journal, you will see that the tool zeroes out the invoices by creating a discount field on the original invoice and posting it to the account used in the write-off invoice tool. This means that the write-off occurred as of the invoice date and may change prior period numbers. Again, this method works for clients that use the cash basis and they don't charge sales tax, and it won't affect any prior period numbers on their cash basis. There are situations when the write-off inventory tool isn't the best way to write off an invoice. And for example, that might be a client who uses accrual basis reporting and the invoice to be written off was in a closed period. And then sales tax also applies to that invoice and won't be paid. So what would you do then? You would create a credit memo to close out the open receivable. First, you would need to set up the credit memo. To do that, you would add an uncollectible or bad debt expense account, and then you would add a service or non-inventory item posting to that account. Alternatively, you could set up the bad debt item and have it posted against revenue accounts. The bottom line will be the same as the first method, but this approach reduces revenue directly without having to separate bad debt expense account. If you wanted to know what you'd written off, you could always look at the item-based reports. Do you have to apply the credit memo manually? One of the options in the advanced tab in the accounting settings is to automatically apply credits. So you may want to turn that on and let QBO apply the credit memo, so you don't need to complete that extra step to receive payment. However, be aware that QBO applies the credit to the oldest invoice first. It does not look for an exact match. So if you have multiple outstanding invoices with that customer, you might want to deactivate that auto apply credit and manually do that. How do you manually apply the credit memo? Once you've set up the credit memo, you can issue it. The way you do this depends on whether your client uses cash or accrual basis reporting. For the accrual clients where sales are either taxable or non-taxable, you would issue a credit memo, apply the credit memo to the open invoice. The credit memo should be dated in the current period as to not change prior period numbers. However, be aware that QBO applies the credit to the old, oh wait, I'm sorry, I didn't go to the next. For both cash and accrual basis clients, if sales tax is applied, you want to issue a credit memo. If you want to reduce the sales tax payable for the amount not being paid, use the same item setup as earlier and mark the line taxable as appropriate. If the bad debt item is mapped to revenue, this will reduce the revenue. If it's mapped to bad debt expense, it will increase bad debt expense. Either way, if the item is marked as taxable, this will reduce the sales tax payable. Again, the date for the credit memo would be in that credit period. What if the client uses accrual basis reporting and the invoice to be written off is in a closed period, or when sales tax applied to that invoice will not be paid? So in this case, you should credit memo date the current period, and that's it. I guess you just don't even worry about the sales tax because you're not going to pay it. Creating a credit memo dated in the current period. Before starting, make sure that the automatic applied credit option is turned off, because remember we were saying it will automatically go to your last invoice. Select the plus sign new, go to credit memo, select the customer, put the appropriate date, enter the product service column, select bad debt, enter the amount, uncheck the text box, because remember we said no tax, sales tax, so we're doing that. What if there was no sales tax, or you're not going to pay the sales tax? You've already paid it and you're going to just eat that cost. If there were sales tax in the original invoice, leave that tax box checked. This will reduce sales tax payable as of the date if you are going to do that, and then click Save and Close. Now apply the credit memo against the invoice. So you would go to +sign new, then you'd go to Receive Payment, select the customer, and then next to the invoice, you want to select Credit Memo and apply it against that specific invoice. And then click Save and Close. In the Invoice tab in the Sales Center, you'll see that the invoice is no longer outstanding and QBO now considers it paid. So here are our questions for this section. When using the write-off invoice tool, what are 2 ways an account user can search for invoices? 1, enter a dollar amount in the balance less than that field. And the other one is use the invoice age drop-down to specify the appropriate period. So remember, I showed you the screen of that. The second question is, which statement is true about the write-off invoice tools? It's best used in the cash basis situation with no sales tax. What is the best alternative to using write-off invoice tools for an invoice that will not be paid? Create a credit memo and apply it to the invoice that will never be paid. The next topic is, oh no, there's another question. While reviewing the unpaid invoices list in your accounts receivable report, you notice that there's an unpaid invoice dated March 31st, and it includes sales tax. The books were closed, and they use accrual basis. You and your client have discussed the unpaid invoice, and you're going to write it off as bad debt. The auto applied credit is enabled. Which entry should you make to remove it? You would create, this is the answer, create a credit memo against the customer and code accordingly. Check that the credit memo has been applied to that specific invoice. Next topic is troubleshooting inventory balances. Many businesses rely on QBO's inventory tracking feature, which uses the FIFO method, first in, first out. This means QBO always considers the first unit purchased to be the first unit sold. It then adjusts inventory and cost of goods sold accordingly when inventory is sold. Usually the balance on inventory reports matches the balance on the balance sheet. However, the balances occasionally don't match. How can you and QBO help? You're likely to notice that balance discrepancies when you run and compare relevant reports in QBO. You can analyze these reports to identify any recording inaccuracies and poor workflow, and then work with your clients to fix these issues. Your first step should be to run a balance sheet report. Troubleshooting inventory balances. So at the end period end, you need to compare inventory reports with the balance sheet. If it doesn't match, check for inaccuracies. So you're running the balance sheet report, and then you're going to select the dollar amount. So when you go to whatever the item is, you go right on top of the dollar amount in the balance sheet and you double click. And when you do that, that brings you to, so here we're looking at inventory asset. You double click on this number right here. And when you do that, that'll bring you to a transaction detail report. And it'll show you everything that happened with that item for that time period. You would select Customize on the top of that report. Choose all dates from the report period dropdown. Scroll down to Filter, go to Product Service box, and choose Not Specified from the dropdown filter. Select Run Report. Because you selected Not Specified from the Product Service filter, this customized inventory asset transaction report will only show transactions that post directly to that inventory asset report. Step 2, review and edit transactions. Review the transactions to determine if they should be reclassified to another account or corrected to include the inventory account. Also, check the transactions to see if you need to adjust any inventory quantities. What if there are too many transaction errors? Suppose the number of transaction errors are too large to correct one by one. In that case, you might determine that an inventory quantity adjustment is the most appropriate way to adjust this error. Due to the FIFO layers, the cost of goods sold effect will be affected. You will have to determine for what period, for example, monthly, you have to create that adjustment, and that will result in a more accurate cost of goods sold amount. QBO allows your client to sell inventory products to their customers and sales firms even when there isn't sufficient quantity on hand. This means that the client is, in fact, selling stock that they don't have in anticipation of getting more supplies, maybe. However, doing this makes their inventory for that item go negative. When your client records an inventory for sales for a product they don't have in stock, QBO has to guess the cost based in historical purchases, because remember, you're using FIFO. So they have to guess what that cost of goods sold is. If there are no historical purchases, QBO uses the amount in the cost field for that inventory item. If there's no historical purchases and no cost amount for that item, QBO assumes a per unit cost of 0. QBO then records the cost as a decrease to the inventory asset and an increase to the cost of goods sold. This allows the invoice to be recorded but can lead to other problems. So how do negative balances arise? When a client records an invoice for which not enough inventory is on hand, and there's two ways that that negative balance can emerge. Example 1, a purchase transaction is dated either before or after an invoice date. In this situation, QBO will automatically adjust the cost of goods sold on the previously entered invoice based on the new purchase cost. It does this regardless of whether the purchase is dated before or after the invoice that recorded the sale of negative inventory. If the invoice is dated in a prior period, the numbers of that period could also change. Example 2, instead of a purchase transaction, someone just entered a figure in the cost field of the inventory item that has a negative inventory. This would similarly affect cost of goods sold in the previous entered invoice. Problems will also occur if the quantity on hand is never appropriately replenished. The inventory asset value and the costs are not reliable because they are based on the QBO estimate at the time of sale and costs are recorded. Negative inventory balances will show on the client's product and service list or their inventory valuation summary report. Both of these can help you identify any items with a negative quantity. You'll see the total inventory counts in that report in the quantity column and in the quantity on hand column of the product and service list. If you find a negative total inventory, run an inventory valuation detail report for that product. The quantity column represents the count of products bought or sold on that transaction. The quantity on hand column represents the running count of products on hand. Review the transaction detail for the negative inventory product to find how far back that negative inventory quantity goes. How do you fix that? Work with your client to determine whether this is a current issue easily resolved with a vendor bill or credit, or whether this involves adjustments to prior periods. Remind your client that they should verify that they have sufficient quantity on hand before recording sales. Explain the negative inventory can lead to skewed financials. Even when purchases are made after the invoice date, which over time corrects the cost of goods sold, skewed financials create problems when they're straddled month or year end and when the client uses profitability reports to decide on price changes. So here's our questions for this section. How do you investigate how long there's been a problem with negative inventory on a specific item? You would run the inventory valuation detail report. Question 2. When the balance sheet doesn't agree with inventory reports, what is the one customization you can make to the transaction report for inventory to help find the issue? You would filter the product service to non-specified. Troubleshooting inventory balances summary. Here's another question. Okay, so here's something there's a couple of pictures. I do remember this question. So there's a couple of pictures. I'm just giving you this one. This one's the setup where you can see that the costs for these widgets are $37.50, $37.50, and that's to the cost of goods sold account. Now, on the other hand, I just wrote out here that based on the item setup and the inventory transaction shows 10 widgets sold. So another picture shows that there's an invoice, and on that invoice you sold 10 widgets. So if you sold 10 widgets, what would be the cost of goods sold for those widgets? Well, you would just simply multiply 10 times each item. Each item, the cost of goods sold is $37.50. So that times 10 is $375. So the total cost of goods sold for that purchase, that invoice that says you sold 10 widgets, you sold 10 widgets, the cost of goods sold for 10 widgets would total $375. Reclassifying transactions. When reviewing the client's books, you may find transactions that were incorrectly classified. This could happen because the client doesn't understand how categories, classes, and/or locations work. In some cases, you'll find a large number of transactions that need to be reclassified. You often need to resolve this at period end. The reclassification tool in QBO allows you to reclassify large batches of transactions. This tool is only available to accountant users. You can use this to reclassify by account, and if the client has a relevant tracking feature turned on, class and location as well. However, you can use reclassifying transaction tools in every situation. In those cases, you will need to reclassify manually. You can open the reclassifying tool by selecting reclassifying transactions from the account tool section. The following are the sections found on that page. So when you open up that tool, these are the sections you'll see. Account types. This panel allows you to specify if you want to look at profit and loss or balance sheet accounts. It will show all the available accounts for that type in the lower part of the panel. If you're looking for a specific general ledger account, enter the account name in that search box. You can also specify if you want to look at a transaction based on the cash or accrual accounting method. To see all transactions, choose accrual. Then there's date range. Use this section to set the date range. Note that the dates are dictated by the date options in the report option in accounting tools. So if you are always wanting to look at last year, choose that. And then that'll be what the report options are for using the reclassifying transaction tool. Type. Select this drop down to filter transaction type. You might use this if you know the specific type of transaction that has to be reclassified and that the rest were recorded correctly. The last one is class. Only available if class, oh no, this isn't the last one. Or only if class is turned on. Here, you could filter by specific class or for transactions that have no class assigned to them. Then you have location, and that's only available if location tracking is turned on. Here, you can filter by a specific location or filter for transactions that have no class locations assigned to them. And then you have customer and vendor. Here you would specify a specific customer or vendor. And the last one is modify. This allows you to filter out any transactions which you can't modify. If class tracking turned on, your choices would be all transactions, transactions for which you can change the class, transactions for which you can change the account. And that last choice wouldn't include any item-based transactions. However, you can change account, class, and location if those last two features were turned on for these transactions. If they're not turned on, you will only see all or accounts. For you to choose to modify by accounts, you won't see any item-based transactions in the grid. By the way, in the training section, they show you pictures of all of this, and it's an interactive, so you'd be able to click on each one and it'll give you the description. Using the reclassification transaction tool, you would select accounting tools and then reclassification transactions. Reclassify transactions, and then you would choose the account types. You would select accounting basis as either accrual or cash, and then from the list on the left panel, you would select the account to review. You can set the date range. You could look at all transaction types if you want. If on the type drop down, you could select all. In the modify drop down, you could select, let's say, accounts, and then when ready, you would select find transactions. Use the check boxes when you see that list to select any transactions that you want to reclassify. From the change account to drop down, select the right account that you want to apply, and then you would select apply, and then these transactions will now be reclassified as a batch. To reclassify the remaining transactions, select the checkbox next to it, select reclassify, and then change the account if you need to, and then select apply again. Transactions categorized by class. So you can use the the reclassify transaction tool for attributing anything that was applied to the wrong class. Because classes affect the targets of the transactions, you want to select profit and loss in the account type dropdown. To look at all transactions, you would then select accrual, and then under transactions, you would want to classify, you would select the dates in which you want to, you would go to modify, and then select all, so you could see all of them. And then find transactions to apply. This shows you where, and this is where you would check all of them here. And then they're showing you here that once you select class, then there would be a class column, and then that'll show you which class is currently assigned to what transaction. So here there's two classes. I don't know if you can see this picture, but this is in the training section. Now choose the transactions that you want to reclassify to a particular class, and then reclassify that. And from the change class to, you would drop down to whatever class you want to change it to, and then you would select apply. After this transaction in the account the transaction in the account will have the correct class assigned to them. Transactions categorized by location. Remember, location transaction tracking must be turned on. You can also use the reclassify transaction tool for transactions attributed to the wrong location. So you can select. You may you might think that you can change or add a location by selecting the source account of the transaction because locations are assigned in the header and they affect source accounts. However, the reclassification tool does not allow you to assign or change locations on the source line, only on the target lines. What if there are multiple target lines on one transaction? In that case, the location will be changed on all lines, even if they post to different accounts. This is because you can only have one location per transaction. So the limits of this tool, the limits of the reclassifying transaction tool. The following transactions can't be reclassified under this tool. Sales tax transactions, because tax payments and tax adjustments are controlled by the tax setting tab. Then you have inventory adjustments, because inventory adjustments are item-based transactions. The next one is billable expense transactions in the income account, because account and settings determines this account. Payroll transactions, because payroll settings control that account. And then item-based transactions like invoice, sales, receipts, checks, and or bills using the item detail grid. In addition, there are restrictions on how you can reclassify certain transactions. For example, transactions that do not contain a customer name can't be reclassified to accounts receivable. Transactions that do not contain a vendor's name cannot be reclassified to accounts payable. How do you change accounts for items? You can't use the reclassification, I'm sorry, I keep saying that, reclassifying transaction tool to change accounts for product and service items in QBO. To change the account for an item-based transaction, you need to edit the item in the product and service list as shown here. So you can also edit each transaction directly with a different product or service item as per the example here. So we have a sales receipt, and I guess we're coming in and we're changing it on the actual sales receipt. Oh, that was a big sale. Did you see that amount? Here's my 2 questions for this particular section. Which 2 of these transaction types can't be batched reclassified with the reclassifying transaction tool? I'm so glad this section is over. The 2 that can't be batched are inventory adjustments and item-based transaction. And the second question is, what 3 fields can be found in the reclassified transaction screen? Transaction type, account type, and date range. The next topic is the prep for taxes tool. Work gets busy at year end and during tax time, even if you aren't prepared, or even if you're not preparing clients' tax returns, you might be reviewing their accounts to make sure they're accurate. The prep for tax tool in the QBO accountant gives you a head start on your client's tax returns. You can use it to review the client's account from a single dashboard, which you can use to display a trial balance. Even if you don't prepare taxes, the Prep for Tax tool can help you with your analysis at year end. After you review, QBO automatically assigns your client account to the proper lines on the tax forms. You can then export the mapped tax forms as a CSV file or to ProConnect Tax Online to get ahead of starting your client's tax returns. You can access the Prep for Tax tool from the Accountant tools. There are 5 tabs across the top bar of the tool. So the first one, Year End Task. The next one is Document, Review and Adjust, Group and Statements, and Tax Mapping. So the Year End Tax tab displays a checklist for tasks to do at the end of the year. You can add, edit, delete, and reorder tasks to align with your firm's workflow. The next tab is the Documents tab, where you can quickly access and view all documents uploaded to the Prep for Tax workspace. There are 2 sections for that tab, and that's General and Accounts. So let's look at the first one. The first tab is Year-End Task. Selecting an item or task allows you to edit or delete it. So the Edit feature allows you to add links to relevant screens in QBO. To do this, just copy the link from the address bar of your screen that you want to link it to, and then paste it in the URL link fields. You can also add links to URL outside of QBO. You can add a new task by selecting the plus add button at the bottom of the screen. Each task has a status indicator to the right. Use the drop down to select the appropriate status, and that status choices would be to do, waiting, and done. And I've showed that in the Pro Advisor. You can add folders and subfolders to both sections. This is in the Documents tab now, that second tab. In the General section, the number of parentheses after each folder name indicates the number of documents in the folder. In the Accounts section, this number tells you how many sub-account folders, not documents, are in the folder. The General section is empty by default. It's best used for documents that carry forward from year to year and that are not related to specific accounts. For example, you might save corporate documents, loan documents, or fixed assets schedules here. You could create your own folders, then add subfolders, attachments such as documents or links to each folder. You can also mark the files in each folder to carry forward to the next year. The Accounts section has a folder for every account in your client's chart of accounts. You can download an entire folder, add attachments, or add a link to a document at any other website or in your own firm's drive. Creating a new folder in the Documents tab. A client asks you to create a new folder for business-related documents that carry over from year to year and aren't related to any individual account. So you would select Accountant Tools, go to Prep for Taxes, go to the Documents tab, go to Plus, Add New Folder, enter a folder name, and then Save. Next to the new folder, select the drop-down arrow and create subfolder. Enter a name to that subfolder and click Save. To see the newly created subfolder, select the right arrow next to the main folder to expand it. To add a document to that folder, select the drop-down next to the folder and select Add Attachment. Locate the file and upload it. Mark files for carry forward and download and save. The Review and Adjust tab shows the balances for all balance sheets and profit and loss accounts for the current and prior tax year, along with the percentage and dollar change columns. It also has a column that shows any adjusting entries made after the Prep for Tax tool was first accessed. In the default view, accounts are grouped by financial statement type, and that's balance sheet or profit and loss. Some firms prefer the trial balance view, which you could switch to using the slider control at the top. This view displays all the accounts in a single column, along with the columns for debit and credits for the current and prior tax year. The beginning balance column indicates the debit and credit balance at the end of the year before any adjusting entries have been made and accepted. The ending balance column indicates the debit and credit balance at the end of each year after adjustments have been made and accepted. You can choose which view works best for your workflow and switch between them at any time. Regardless of which view you choose, selecting any account balance automatically brings the reclassifying transaction tool. To change which columns are displayed in your Prep for Taxes workspace, select the grid gear icon at the top right of the table. You can also expand or collapse rows to show or hide sub-accounts. This enables you to adjust your screen view as you work through each account. The Review and Adjust tab is also where you can make an adjustment, add a note, add or manage attachments. These attachments will also appear in the Account section of the Document tab. The Group and Statement tab, that enables you to group your accounts into whatever structure works best for you and your client. You can create groups, rename current groups, and drag and drop accounts into your groups you choose. Grouping accounts is an essential feature for larger CPA firms that need to prepare specific financial statements. To create a new accounts group, select the plus Create New Group and enter a group name, reference code, and a note to let others know what you should be including in this group. This is helpful if your firm uses different financial groups for those clients that use management and other reports. After creating a group, you can drag and drop the accounts that should be included in it. The Tax Mapping tab provides a quick and easy way to see if each account maps to the right tax field and to make changes if needed. You can then export the mapped tax file into an Excel file. The first time you use Prep for Taxes, you'll be prompted to select which tax form to use. You can change this form at any time, however, you'll need to remap some accounts. On subsequent visits, the Tax Mapping tab shows you which tax line it has assigned to each account. QBO will attempt to automatically assign tax lines to the chart of accounts. Any unassigned accounts appear in the We Found Unmapped Accounts section, and you would select Assign Tax Line and move them to the correct tax line. Exporting to ProConnect. So ProConnect is a cloud-based online professional tax software from Intuit. It allows you to accurately prepare business and individual returns. After you review and make any edits and adjustments in your prep for taxes, you're ready to export to ProConnect if that's what your client uses. Select the tax option drop-down that you see over here, and you would select either update existing return, create new return, or you can also choose export CSV file to download a CSV file that you would be sending to wherever. If you started a return in ProConnect Tax Online before working in the prep for taxes, or you made changes since your last export, select Update Existing Return from the list of options. Keep in mind that this overwrites any current dollar amounts in the ProConnect. If your workflow means that you finished work in the prep for tax before the starting a return in ProConnect, then select Create New Return. This creates a new return in ProConnect as well. If you don't use ProConnect, then use that third option, Export CSV File, and that's where you would send it to whatever third-party tax or any software that you use for taxes, and you'd be able to upload it there. So here's my questions for this section. What are the 3 key features of the Prep for Tax tool? You can store account-specific documents. 2, you can create new groupings for financial statements. And 3, you can carry over tax mapping from the prior year. Question number 2, what can you add to a current tax from the year-end task tab in the Prep for Tax tools? You can add, the answer is links to screens in your QBO. And then the last one, when would you use Prep for Tax tool? And the answer is at the income tax year end, so at the end of the year. Our next topic is preparing and filing 1099 forms. If a client pays an unincorporated business $600 or more, then they need to make sure they fill out that W-9, and they need to give them at the end of the year, or by January 31st, that 1099. And there's 2 types. There's 1099 NEC and there's 1099 miscellaneous. Note that QBO, Simple Start, Essential, Plus, and Advanced subscription levels all have the 1099 wizard that'll help you in linking that to the IRS. 1099s are informational reports used to report certain types of non-employment income to the IRS. There are 20 different types of Form 1099 for reporting things like interest, dividends, rent, payments for services rendered, and much more. QBO will help you and your clients fill out 2 commonly used 1099 forms, and that's the NEC and miscellaneous. The NEC is for any unincorporated business, like freelancers like me when I do my pro advisor work, or part-time workers that aren't getting their taxes taken out. They're providing a service, basically. And then the 1099 miscellaneous would be for rent, royalties, prizes, or awards. When should a client issue a 1099 NEC? If your client paid $600 or more to an unincorporated business during the year for services rendered, they would need to send that business a 1099 NEC. This form serves 2 purposes. It allows a client to report payment and also allows the unincorporated business paperwork to do their taxes. What about the Form 1099 miscellaneous? That's used for other payments to unincorporate. For example, a small business often needs to file miscellaneous if they paid, let's say, $600 or more in rent. For more guidance on when, you could go to the training section, and there's guidance from the IRS in this particular, because I know some people ask on that. QBO treats contractors as vendors. You'd put them in as a vendor. So, and you would come down here, you'll see there's an option, there's a box that says track payments for 1099. That's where you would check that, and you would let QBO know that is a contractor. The client needs to identify which accounts to pull information from to complete the 1099 NEC and MISC forms. The client should review any transactions related to the vendor before preparing the forms. This helps ensure they're posting the transactions to the correct accounts. Then they need to report monies paid to freelancers, independent contractors, and gig workers in their NEC forms. Clients can still use the form miscellaneous to report other payments such as rent, royalty, and gross proceeds, let's say, to an attorney. Should all payments be included in the 1099? No. Your client should include all payments on the form. Should not always include all payments. These two 1099 should include cash and cash relevant checks, or EFT, which is electronic funds transfer payments. However, credit card, PayPal, and debit card payments are recorded in the 1099K instead. This form is issued by financial institutions, so your client shouldn't report these payments on NEC or MISC. Otherwise, these forms would be incorrect. Okay, so if you used credit card, PayPal, or debit card, that they get a 1099K. Okay. Clients need to know how to indicate which payments should be included or excluded from the 1099 miscellaneous and 1099 NEC forms. If the payments were made by credit card, then QBO will know to exclude them. However, if the payments came from bank accounts, what the client put in the reference field is what's important. You and your client can see what they paid their contractors by running a 1099 report. You can find these reports by searching 1099. So you go to reports in your navigation, you start typing in 1099, and you'll see all your 1099 forms reports come up in there. The 1099 wizard helps clients create their 1099 miscellaneous and NEC forms. You go to the payroll menu, select contractors, select prepare 1099, and it'll say let's get started. You ensure your company name, address, and tax ID are all correct. You select the boxes that represent the type of payments that you'll be reporting. For each box, choose the account for which QBO needs to pull the payments. Important, you can't choose the same account for more than one box in this form. So for example, if rents and services post to the same account, you need to split them into different accounts. To do this, you can edit the original transaction or make actual journal entry. Then you would select next. Verify that all your contractors receive the 1099 and that are shown, and their addresses and their tax ID and emails are all correct. Ooh, sorry. Did that by mistake. Verify that all your contractors should receive 1099 or shown. Oh, I did that already. If you're missing a contractor, just add them from the vendor list. All right, here's our questions. All right, that was the last. Oh, no, I have one more. I'm sorry. If you e-filed your 1099 on QBO, you can access archived 1099s from January 1st until April 30th of the next year at any time by signing into your 1099 e-file account. Once you've signed in, you select View Past Forms. You can print 1099s here. I mean, obviously, this would be if somebody didn't get it or something happened to theirs. They call you and say, can I get another one? Once your 1099 is complete, choose the I'll file myself option. Choose the type of form you're printing. Check if the forms align properly. And just know that there's certain paper that you have to purchase and you would put in your printer. Okay, just so you know that. Now let's go to the questions. You've been hired to prepare 1099 forms for your client. Here are the related transactions for that year. So Books by Bessie was paid $100 per month for 12 months. Computers by Han was paid $700 by debit card. The landlord, John Johnson, was paid $100 by EFT. Newsy Advertisement was paid $500 by check. And your CPA was paid by $1,200 by check. So which vendor should receive the miscellaneous? Remember, that's rent, so that would be John Johnson. And then which two vendors should receive a Form 1099 NEC? Now, this was sent to me, and they have Computers by Han and Nancy, which is your CPA. But I noticed that Computers by Han was a debit card, and I looked back here and I saw that they said credit card was not an option, but I didn't see debit card. So I was assuming that that was correct. I'll bring you back up to that screen that says that. So it says, it does say, however, credit card, debit card, and debit card has to be 1099. So that's not correct. So the only other person that I think this is a horrible question, to be honest, because somebody sent this to me and they asked me, and this is the two that they put. So it can't be Computers by Han because that's a debit card. The only other thing that I think would, because this would be advertising expense. So the only other thing would be Books by Bessie, which is weird because I would assume that's a subscription. But I'm going to go ahead and change that to Books by Bessie. This is one that stood out to me because I didn't know. They were actually asking me the question, and I didn't know looking at it. Now that I reread it and see debit card, but it's a tricky one because I feel like newsy advertising, that'd be advertising expense. And Books by Bessie, I'm assuming if you're paying $100 a month, that's some sort of subscription, and that should be under subscription expense. But it's just not, there's just not enough information in this question. I don't know if it's still on there because it does look a little shady to me. But if it is on there, I'd go with Book by Bessie and Nancy. Please share if you know something or if you want to contribute to this particular question. Please share in the comments because I'm curious. All right, our next topic is closing date and the exceptions to closing date report. When you or your client finish reviewing a financial period, you'll want to lock it in and ensure no changes are made. So you're probably going to want to put some sort of password. QBO allows you to close your client's book at any frequency you or they prefer. To help prevent changes, once you close them, you could set a closing date and even a password. Once you do that, a report is made. There are 3 ways you can start closing the books. You could select Accountant's Tools and then close books. Select the Close Now link in from the Wrap-Up tab of the Book Review menu. Those are 2. So you can select Accountant Tools and then close books, or the other one is select the Close Now link in the Wrap-Up tab of the Books Review. The third one's because these ones are both under the Advanced tab and Account Settings. You can navigate it through the gear icon Account Settings, okay? And then you go to Advanced tab, and then from here you can start the process. Once you're in the Advanced tab in the Account Settings, select anywhere in the accounting section to enable editing, and then use the Close Book slider to start the process. Set a closing date. It could be the current date, although typically it's at the period end. To protect the books with a password, you're going to select Allow Changes after reviewing a warning and entering a password. By the way, this particular one we're doing here now is the way I'm familiar with doing it. So you put a password if you'd like and enter it and confirm. Select Save and then Done. Now your books are closed. When you close your books, you should protect them with a password. This prevents unauthorized users from making changes to the books once they're closed. Bear in mind that only the primary admin or company admin, including the accountant user, can set, change, or remove a closing date or change the password. They could do all these tasks without even knowing the current one that's there. What should you or your client consider when setting a closing date? It's best to create or update a closing date when your client is fairly certain that all the day-to-day transactions for that period have been entered. If they still have some things they're working on, do not close. The closing period also applies to non-posting transactions such as estimates and purchase orders. Reconciliations can be conducted in closing periods without having to enter a password. The exception to closing date report is an audit history of all the changes made to transactions dated before and including the closing date and made after the books were closed. The report allows you to track any changes that were made regardless of whether the books have password protected or not. Once you set the closing date, you can access the report through the Report Center in the For My Accountant section. If no closing date is set, the exception to closing date report will not be available. That's a Pro Advisor question. You'll only see the details in the report when there's a transaction edited that was dated on or before your closing date. If the report shows nothing, no transaction were changed by any users in the company. What happens if you change the closing date? If you change it, then the existing exception to closing date report will be erased and reset and started from scratch. You'll only be able to track changes that occur after the new closing date. That means that it's a good idea to save your existing exception to closing date report as a PDF before changing your closing date, so you have that to refer to. If you want to print the report, you could select Print. Here's your options: email, save as PDF, or print. You'll see the exception closing date report doesn't initially display details. However, there are groupings that can be expanded to display the detail in each grouping. And you can expand all of these grouping by selecting Show All link at the top right corner of the report. Select the link before saving the report as a PDF or printing it. So here's my questions in this section. What 2 statements about the closing date are correct? These are the 2 statements. A user with administrative rights can change the closing date and password. Any accountant user can change the closing date and password. Those are your 2 answers. Here's a question. From which 2 access points can an accountant user close the books? Remember, there's 3 that they mentioned, but they're only asking for 2. And in there, the 2 that are And the choices are accountant tools, close book, gear icon, account settings, advanced, accounting, close books. Close the books. What is the reason why the exception to closing date is not visible in the report center? The answer is the closing date has not been set. The next topic is converting QuickBooks Desktop to QBO. So although many clients start their experience with QBO, many others are using desktop. Although I see more in the last decade, more and more people are going into QBO. So desktop for Windows, Pro or Premiere, or desktop for Mac, or QuickBooks Enterprise all come with a built-in conversion tool, allowing their clients to convert their data to QBO. However, without expert knowledge and support, clients may find it daunting to complete the conversion process, so they may ask you to help for the migration. The built-in conversion tool allows you and your clients to migrate their financial data automatically at the click of a button. That said, you'll need to do some preparation to make sure everything is ready. So step one, make sure you already have a QBO account set up. So that's the first thing. The first thing you should do is create a new company with the QBO information. This allows you to choose the correct level of subscription and who's going to pay for it. So step one, create your QBO. Next, create a backup of your desktop data. A backup creates a restored point for the QBO desktop data right before you export it to the QBO. It's a precaution in case your client continues to enter data in the desktop file, so you can compare the live data to the version in the file you converted. This, because remember, it's a downloaded program, so they can continue to use it if they choose so, but they need to remember whatever they put in their desktop version, they must put in their QBO as well. The existing QBO desktop data isn't altered, damaged, or erased when converted to QBO. That's another plus for doing that. How do you create a backup file? In the desktop, you would select File, and then you would select Backup Company, followed by Create Local Backup. Now, there is a limit of 350,000 targets, so you need to make sure that you don't go beyond that, as if you go beyond that, an error message will come, and it'll say it's too large. Consider using the Condensed Data Utility Reduce option to reduce it. You don't want to convert a corrupted file, so verify the integrity of the file first. To verify it, you would go to File and then followed by Utilities or Maintenance, and then select Verify Data. If you get the following message and it says we found some errors, then you want to make sure you handle all that until you're good to go. You can try to fix the file by performing one of the following maintenance activities. Repair your file using the Rebuild Data tool, repair your file by using the QuickBooks File Doctor, or manually repair your company file by rebuilding your data. You can also carry out one of these maintenance activities if you just want to clean up your desktop data file to make it as trouble-free as possible, even if you didn't get an error message. Make sure you have the most recent versions of your desktop conversion tool. To check and update the conversion of the tool, do the following. In your QuickBooks Desktop, navigate to Help, then select Update QuickBooks Desktop. This opens a window with 3 tabs. You would select Update Now, and then go to the Overview tab, select Get Updates, and then Update Now. Then exit. It's best practice to check that any features you don't want to convert QBO aren't turned on. So do this by going to Edit in your desktop, and then go to Preferences, and then turn off any of the things you want, like account numbers, class tracking. Notice that if this preference is turned off, class tracking won't be turned on in QBO. And so you can then, once you get everything, all your information in, you can then turn it on. What doesn't convert from desktop? When you're converting QBO, there are certain things that won't apply. Because not every feature in the desktop converts to QBO, you may notice some different or missing data after conversion. Some features work differently in QBO than they did in desktop, so you'll have to make some adjustments after migration. Some data won't convert or transfer automatically, and you'll need to add that manually. We'll talk about which ones those are. Generally, if your desktop feature or transaction type exists in QBO, it will convert. Desktop features such as sales orders, price rules, and sales reps won't convert because there's no QBO equivalent. What features of QBO will not convert? Custom sales form templates, bank connections, QBO user and permissions, reconciliation reports that you already have, memorized reports, the desktop audit trail, any connections to your QB payment information needs to be re-put in. Balance sheet budgets, although profit and loss budgets do convert, balance sheets do not. Any attachments that you have in your file do not come over. And then the last thing, any closing date password or accumulated closing date exceptions do not convert. How to perform the conversion process. Once you're finished with the pre-conversion work, you're ready to carry out the conversion. So you would go to your desktop, go to company, select export your company file to QuickBooks Online. Because you already have your subscription set up, all you have to do is move now, put in the information. You can choose to say I track inventory in QBO and then click Save and Close. To complete the task, you'll need to confirm if you want to initiate the conversion process. To do this, carry out the following steps. Choose whether to sign into your QBO account or create a new one. Enter the verification code that was sent to you via text message, because you would have gave them a phone number. Select the destination company you want to move your desktop file to, and then click Continue, and then select Upload. You'll see the conversion process as it takes place. The conversion tool will email you when the conversion is complete. The email will include an import summary report about the conversion. If you as a lead accountant are doing the conversion, the email was sent to you. If another team member was doing it, the email was sent to the lead assigned to the client. If payroll and inventory were active in the desktop account, they will also convert to QBO. During the conversion process, you'll need to add missing information. The active features and configurations are required. Let's look at what you'll need to be aware of in converting these two things. If payroll was activated in desktop, then it'll be activated in QBO. What do you need to be aware of with payroll? Company payroll information, including federal and state tax information, identification numbers, tax remittance frequency, and tax rates do not convert. So you need to go into payroll and input those things for your client. Paychecks and tax liability and payment conversions as regular checks. Tax payment history, in a sense, does not convert. So that's, again, you have to probably print that out from your desktop version and keep that in your records. Direct deposit, electronic tax remittance, and e-files, they do not convert. And you'll need to set that up again in QBO. Workers' comp integration does not convert. Local tax settings do not convert. The year-to-date payroll summaries for each employee converts to the payroll module. However, because the paychecks convert as checks, individual paycheck details do not convert. So you can read all of this actually in the training section. Now, inventory. You'll be asked if you want to bring your inventory into QBO. Note that inventory tracking is not only available in QBO, it's only available in Plus and Advanced. So you could select Yes, tracking inventory using FIFO, and you'll need to select the starting date. Note that once you set the inventory starting date, you won't be able to change it. So you want to make sure you know what date you're putting in there, because you'll only be able to sell and deal with inventory from that date on. They'll email you instructions on what to do. If you select no, don't move inventory, you'll be able to set up inventory items later manually. Just know that if you do, they automatically create 2 additional items in your chart of accounts, and that's item inventory asset deleted and item cost of goods sold deleted. Okay. And that's because all your desktop inventory items will convert as non-inventory items in QBO. So you'd have to go in and manually change any of those things. That needs to be appropriately mapped. Ooh, looks like a slide was erased. All right. The next one is troubleshooting and making adjustments. Most of the time, converting from desktop to QBO is quick and easy. However, you may encounter some issues during the after conversion. So in addition, certain features such as lists and transactions are set up differently in QBO than desktop, so you might have to make some changes or adapt them during the conversion process. If you have trouble importing your company file from desktop for Windows into QBO, try rebuilding the data file and restart the export process. Even the most straightforward process doesn't always go the right way in time. Just so you know, as a pro advisor, I usually help people get set up and train their employees. When this first started, I had a few clients, and some of them I just said, I'm sorry, I can't. I mean, I was helping them initially, but we realized the conversion process was just not, and they were going to have to manually input everything. I was willing to train them on that, but that wasn't the original contract. Post-conversion activities. Once a conversion has been carried out, you need to carry out several actions to make sure everything is in order for you and your client. To ensure your data was transferred correctly, complete the following reports in QBO. You want to do your balance sheet and your profit and loss reports. You want to look at the ending balances you had in your desktop and compare them to now what you show in QBO. And take into consideration that FIFO date that you put in there, okay? And they're saying make sure inventory balances agree as of that date, and you want to use all dates. You should review all of the options in your account and settings in QBO to ensure that all the features your client needs are turned on properly. That's always the first step in anything, whether you're doing desktop or creating from scratch. What if sales tax converts to manual instead of hybrid version? Well, then you're going to go into the sales tax and you're going to properly, put that to, whatever, if you want the hybrid and you want it to automatically apply sales tax, let's say the location, then you adjust appropriately. The connection to your bank and credit card accounts does not carry over from desktop, so you'll need to reconnect all of those bank feeds and credit card feeds. As this is a new QBO account, you may want to do an initial reconciliation on all your bank and credit cards to make sure that everything is reconciled appropriately and all your ending balances and ending dates line up with what you have in desktop. Other tasks you might want to complete after conversions: creating and saving new custom reports, setting up users and permissions to the users, setting up and implementing chosen third-party apps, completing payroll setup, as described earlier in the lesson. There's a lot that doesn't convert, so you need to complete the payroll, and relink your payment, because remember your QB payment account needs to be relinked. So here's our questions. When using the QBO desktop conversion tool, what are 3 items that will be excluded from the converting? Attachments, user permissions, and balance sheet budgets. Here's a second question. After converting from desktop, what are 2 reasons that the balance sheet and profit and loss might not agree when comparing to the desktop? QBO to desktop. 1, the reports were run on different accounting methods, and 2, FIFO tracking date is different from the conversion date. Here's a third question. After selecting no, don't move inventory, which 2 statements are true when converting from desktop? Here's the 2. QuickBooks Online will add 2 new items and inventory. Here's the 2 items. Item inventory asset and item cost of goods sold will now be active. So those are the answers that way. I think we have a second page. Which 3 steps are considered best practice prior to using the conversion tool in QBO Desktop Pro or Premier? The answer here is use the Verify Data tool to make sure the integrity is good. Verify that the total transaction count is less than 350,000 and create a backup of your data file. And here's the last question. Ivan's IT company, a service-based company, uses QuickBooks Desktop and needs to invoice regular customers automatically on a weekly basis. They also generate a sales by customer by report on a monthly basis. Enter credit card information on real time. After converting to QBO, which 3 steps and customization steps would you make for this client? We have customize report, review reoccurring transaction, and connect the credit card through the banking center. All right, importing data, second to last topic, since we're almost finished. Some of the new clients might not have data in their QBO products, and others might have data in desktop and they might not want to convert it. So in both cases, it could be tedious and time consuming to enter lists individually, so you might want to just import them directly into your QBO account. So you can import several different types of lists to QBO. However, you can only import them one at a time. And then QBO has a built-in importing tool that allows you to import an Excel or CSV file. And even now you can connect files through Google Sheets. That's new, Google Sheets. So when reviewing the import screen, be sure the item type is correct before selecting import. Checking the box in the track column tells QBO that it's an inventory item. If the item should be a service or non-inventory type, uncheck that box and use the type drop-down to specify which type it should be. You need to map inventory items to an income account with the sales of products income detail type. For service and non-inventory items, use the sell and buy columns to specify whether you want to use them or use the item on a sales form or a purchase form. Check both boxes to use them if you're going to do that double-sided item. To then make sure to identify the correct income and expense accounts. If there's a matching name, you can check to overwrite all values for each product or service that you want to import with the identical name. This can be undone if you want. If there is no matching name in the existing list, QBO will add the new item. QBO ignores any records with no check marks in the sell by or track column. So to keep that in mind when we look at the question, because one of the questions I was like, well, I wonder what the options were. When reviewing your import, oh, I did that. I can't get to the next one. I think I'm lagging. When importing the chart of accounts, you must ensure that the account type and detail type match. QBO predefines options for each field. You don't enter this information on your Excel spreadsheet. You can upload the account names to QBO, then select the account type and detail type from a drop-down field in the import screen. So if it doesn't, you can manually override it. Account names contain a maximum of 100 characters, including alphanumeric and special fonts. Apart from sub-accounts, account names cannot contain colons. To import sub-accounts, make sure that the parent and sub-account appear separately by a colon. And here's an example. So you have name, colon, sub-account name. For example, that was for example, on the spreadsheet. The address, city, state, and zip need to be entered as separate fields. If the address in one field on the existing list of customer and vendors, make sure to parse and break this data into separate fields for each record then. Also, make sure you clear the opening balance and open balance date fields. If you import the opening balance, QBO will create an invoice for the customer or bill for the vendor and for the opening balance amount. For these, I've imported many a times. For this, just to give you the heads up, you might do a little trial run and then see what the results were. And if it's all kooky and crazy, you'll realize, okay, these are the fields that are set up and this is how I need to import it properly. Here are the questions. And as I said, there's one we're going to look at together in a second. Which statement is true when importing lists into QBO? When importing lists, check the box to override products and services with identical names. That's the answer. Here's another question. An owner wants you to help their company set up with QBO as of the beginning of next calendar year. They have been tracking inventory with Excel spreadsheets, but they want to use QBO to track inventory. They have given you a spreadsheet to import. Use the table on the next slide to see what is wrong. So here's the table. And I saw that the person that sent this to me, they automatically had the answer as incorrect type. I don't know what the actual selections were in here. That's why I just want you to know. But I did make this as big as possible so you could see these three right here are not selected. And then it automatically has, did not import as the name, and then no type was selected. So I don't know what the choices were. So there definitely isn't a type. So that could be an answer. But also, if you go back to, remember I told you keep that in mind, one or more of these have to be sell, buy, and trade have to be selected. So I did put that over here as the note. QBO ignores any records with no check mark in the sell, buy, or track columns. So if you do get this question, see what the other options are. Then the last topic we're going to go over is setting up a new QuickBooks Online company from scratch. So some clients who move from desktop to QBO are not happy maybe with the conversion tool. Some are. The ones that aren't, you would have to then start from scratch. And then there's some that are coming from different type of softwares, and it's just not possible to convert them over. Both you and your client need to prepare appropriately to set up the company. You'll need to add beginning balances, outstanding checks, deposited, open accounts receivables, accounts payable transactions, unbilled charges is inventory. If you're prepared and know the right steps, entering the beginning balances for a new company in QBO could be very straightforward. To ensure opening balances are accurate, you'll need to get the following information from your client. The start date for the QBO. The start date is the day you want to start entering transactions. However, your opening balances should be dated before the start date. So the trial balance for the prior period, you want to look at all your ending balances on that trial balance. Any and all open transactions that have been reconciled. This includes checks, deposits, credit card charges, and credits. Gather all open accruals that haven't been paid, including accounts receivable, accounts payable, and sales tax payable. Any and all information about inventory items, including quantity on hand, sales price, taxable status, and cost. Non-posting entries, enter any open billable charges, as well as open purchase orders and estimates. If the conversion is happening mid-year, you can enter month-end balances for income and expenses to run comparative trend reports to these periods in the future. Be sure to keep a copy of detailed transactions for these monthly balances for supporting documentation. So simply put, you're entering beginning balance data, and value means posting a series of transactions with offsetting amounts to the opening balance equity account. That is a journal entry. You're manually going to put a journal entry in, and you're going to put in account balances, and you're posting that against your opening balance equity. As we said earlier, that's when you were originally starting your business. That's what it's going against. So if you were doing it through the conversion tool, it'll do that for you. But if you're manually doing it, you have to manually do that journal entry. Enter any outstanding checks and deposits using the original dates, amounts, and the appropriate check or deposit transaction type. Select the appropriate bank account for the outstanding transaction and post these transactions to the open balance equity account because you have already recorded the income and expenses for the prior year to the retained earning account in the previous step. These transactions will net with the bank balance you've entered in the previous step's journal entry to arrive at the prior period's ending book register balance. So enter open accounts receivable transactions with the original date and amount using an invoice or a credit memo. If the company reports on accrual basis, you are going to set up a service type term calling it beginning balance and select the opening balance equity account in the income account field. You can then use the beginning balance item when you're entering open invoices or credit memos because the income has already been reported in that prior period. If the company reports on a cash basis, recreate the original transaction using the client's regular list of product and service items that post to the income accounts. Once payment is received, income will be reported appropriately. Enter open account payables transactions with the original dates and amounts using a bill or vendor credit. So the other end of it. If the company reports on an accrual basis, post the bill or vendor credit to opening balance equity. This is because those purchases were reported in a prior period. If it's a cash basis, recreate the original transaction again, as we've seen with the other side, accounts receivable. Enter any unbilled charges that still need to be invoiced. Remember, these are non-posting transactions. Unbilled charges can be grouped into unbilled expenses. Enter any unbilled expenses using the delayed charge transaction type because you don't want to record the expense a second time. Use the original date the expense was incurred and the original amount. Unbilled time. Enter the unbilled time in a timesheet, assign it to a service item, and customer mark it as billable. Again, use the original dates and hours that were worked and performed. Enter open non-posting activities such as estimates and purchase orders that you want to reference or link to future sales and purchase forms. If you use QBO payroll, you'll need to review payroll tax payables and adjust them as needed. To allow the business to run a historic comparative profit and loss by month, you need to enter mid-year income and expenses if applicable. Use a journal entry dated for each month to record the total of that month's profit and loss account activity. Enter offsetting amounts to retain earning accounts so you don't duplicate the income and expense you already posted to retain earnings. Remember to check whether your client entered their beginning balance as of the start date rather than the day before. If they also enter the transactions as of the start date, the reports between their old system and QBO won't agree. If your client uses inventory, you'll need to ensure that the products are added to the product and service list and that the beginning balances of each are entered. This can be done in a few simple steps. You can go to item type and then select inventory, For each product, enter descriptive information, but especially the initial quantity on hand and the quantity as of date and the per unit cost. What happens next? As you or the client saves each new product in the list, QBO will multiply the quantity and the cost and post the amount as a debit to inventory asset and a credit to opening balance equity on the date specified by the client. Is there another way to enter inventory items? If there are many product and services, the client can import inventory items and related beginning balances using the import tool we talked about a minute ago. What if the client wants to use a third-party app to track inventory? Depending on the complexity of their inventory requirements, clients may prefer to use a third-party app, and in that case, follow the instructions regarding the integration for QBO. A lot of those, you have to actually go through the third-party app to set up integration. Your clients will also need to record sales tax liabilities. Although